If you're an investor, you have to understand how to diversify your money. And in this video, I'm going to show you 7 different ways that you can do just that. You've heard the saying, don't put all of your eggs in one basket. And the same lesson holds true for your money. Diversification in investing is similar to diversification of your eggs, but instead of protecting your eggs, you're protecting your money. I'm Mark Palmer, ex-financial professional, here to help you build wealth. You can follow me on Twitter or Instagram at MarkPWealth. Before we get started, I have a quick favor to ask, and that's for you to hit that like button on this video and subscribe to my channel. Super easy for you to do, and it really helps me out a lot, so thank you. One other disclaimer here, this is not financial advice, it's simply financial education. If you want advice that's specific to you, go find a financial advisor, they'll be able to help you out. Now, as we get into diversification, don't be fooled. There are plenty of people out there who have invested all of their money into one single thing and made themselves rich because of it. On the flip side, there have been plenty of people who have invested all of their money into one thing, only to see that one thing crash and burn and take all of their money down with it. You're free to invest your money however you would like, but there's one thing that financial gurus do mostly agree on, and that is to spread your money out among different investments. This is how you reach diversification in your portfolio. And the whole point of a diversification is that if you have one investment that goes wrong and all the money invested in it is lost, you still have money in other investments that have your back and keep you afloat. The old don't put all your eggs in one basket metaphor can be taken even a step further with investing, and then even steps further after that. With investing, it's kind of like don't put all of your eggs in one basket, and then don't put all of your baskets on the same truck, and then don't drive all of your trucks on the same road. There are many different ways you can diversify and give yourself added layers of protection with your investments. Let's get into 7 different ways that you can diversify your investments. The first way is probably the most basic, and that is to invest in different companies. For example, instead of putting all of your money into company A, you decide to split your money in half. Have half go to company A and half go to company B. It's that simple. That gives you some diversification. The next method is to invest in different asset types. For example, you could invest in stocks, you could invest in bonds, you could invest in cryptocurrencies, you could invest in real estate. There are lots of different asset types that you can invest in and you can use to diversify your portfolio this way. The third method of diversification is regional. I know a lot of people like to be patriotic and invest in companies that are based in their own country, but that can cost you if your country goes through some sort of crisis and you are only invested in companies within. Think about all the other countries and continents out in the world, as well as different markets such as emerging markets that you could invest in and spread your wealth. The next method of diversification is to diversify your investments amongst different sectors. For example, you could invest in technology, you could invest in healthcare, you could invest in financial services. These are all examples of different sectors that you could put your money and spread your money out to diversify by sector. The next way to diversify your investments is by different investment styles. 3 main styles of investments are value investing, growth investing, or a blend where it's value and growth blended together. Growth companies are companies that people believe have not yet achieved their full potential and have the potential to outperform the market for years to come. These companies' stocks tend to be a little more risky than value stocks because they tend to fluctuate in price a lot more than value stocks do. Currently, Amazon is a great example of a growth company. Value stocks, on the other hand, are companies that are well established and that some analysts believe the price of their stock is less than what the company is worth. Value stocks are typically a little less risky than growth stocks just because their price is less likely to fluctuate as much as growth stocks. An example of a value stock would be General Motors. Sometimes when researching investments, you may see a 3x3 grid that looks like this with 9 boxes within it. This is used to describe where that particular investment falls on the investment style scale. So going over the columns from left to right, you have value, blend, and growth. And going over the rows from top to bottom, you have large, mid-cap, and small. So a large cap value company may show you on its stock report that it has the upper left box of this grid filled out, showing this is a large cap value style stock, whereas a small cap growth company would have the bottom right box of this grid filled out. As companies grow, they can change to different spots within this grid. They can change their style. They can go from value to growth or growth to value. They can go from small cap to large cap, or even from large cap to small cap. The next way that you can diversify your investments is the account type that you invest in and the tax implications of that account type. I'm not a tax professional, but there are different account types that have different tax implications, and some of which have benefits to you investing within that account type, because you can either defer your taxes to later or pay taxes now and not have to pay taxes on the gains later, or various other tax implications. And I do actually go over some of this in another video of mine, which I will have a link to pop up on the screen right now for you. Be sure to work with a tax advisor if you do have questions about diversifying this way. The seventh and last way that we're going to go over how to diversify your investments in this video is the time horizon of your investments. Now, this is a little bit more basic of a method, but it is definitely something you want to understand, because if you have certain money that you're allocating towards your retirement, whereas you also have certain money that you're allocating for something you're saving for in the next couple of years, you're going to want to put this money into separate baskets. The reason for this is different investment vehicles have different levels of risk, and they have different time horizons that they typically work best for. So it's important to understand what you're putting your money into and what the purpose of the money that you're putting into these investments is. Bottom line, long-term versus short-term investments is something you'll want to understand, and there are plenty of options out there. We're not going to dive into each of them today, but just think about stocks being something more long-term, whereas a savings account or maybe even a CD or some sort of fixed income method being more short-term. As you can see, diversification can go far beyond just simply choosing different companies to invest in. By spreading your investments across different asset classes, different regions, sectors, styles, tax implications, and holding periods, you can build a well-rounded, diversified portfolio that decreases the amount of risk exposure you have. One easy way that you can invest and diversify your investments is through mutual funds and ETFs. These will get you invested in tons of different companies, perhaps in tons of different sectors, or you can buy multiple ETFs, one for each different sector or different style of investment. You can even have these funds track different asset classes. You can have them for different holding periods. There's lots of ways that you can diversify your investments at the click of a button by investing in just one fund that spreads your money out across all different companies and covers multiple ways of diversifying your investments. But you can also choose to build your own diversified portfolio by hand selecting different investments. It requires a little bit more work, but for investment nerds like me, it's kind of fun. My favorite platform for doing this is M1 Finance. You download the app, super easy to use, and you can handpick each company that you want to invest in, what percent you want to invest into that, and every time you deposit funds into your account, it'll automatically spread them out amongst your portfolio. Makes everything super easy, and it's fun to do. Right now, they have a promotion where if you use a referral link, such as the one that I have in the comments or the description of this video below, you can get $50 for free if you deposit $100. I'm a big fan of free, easy money that I can invest with, and if you are too, this is one simple way to do that. Just click the link down below, start your M1 Finance account, start building your portfolio, and they'll give you a boost of $50 just for doing so. I'd love to hear your thoughts on how you diversify your personal investments. Please leave those in the comments below, or if you have any questions, you can also comment those below. You can always reach out to me on Twitter or Instagram at MarkPWealth. Really appreciate you taking the time to watch this video, and if you have not yet, please do subscribe to my channel, like this video. Really appreciate you doing that. It helps me out a ton. Thanks again for watching, and we'll see you next time.